This is Robert Kraft. I am your host for the Investors Roundtable. This is the 5th episode of the show. And in honor of opening day, baseball finally being back, and also my first time back in the office, first time wearing the mask. And look, me and Kevin did not plan this. This just happened to be a thing. But, I appreciate you all joining us today. My name, again, is... My name is Robert Kraft. Again, I'm your host for this show. Joining me today via Zoom is Stephen Kiel from Willow Oak Asset Management. We got Kevin Shea, full-time private investor and MicroCapClub contributor, and Yaron Naymark from One Main Capital. And joining us just via audio. One day he will join us via video as well. We got Mr. Chris Irons, Quoth the Raven himself, joining us. Gentlemen, thank you for joining me today. How's everyone doing?
Hey, thanks, Robert. Go Cubs.
There we go. Okay.
That's why we're talking about Lester.
Thanks for having us on.
Cool. All right. Well, I figured we kind of get started with our guest that it's his first time on here because he hasn't given his he's given his general assessment on his own show on Twitter. If you know him, you love him. Chris, since the last time we spoke, and I remember specifically you said, Bobby, you only talk to me when the market's down like crazy. We've seen a little bit of a recovery since. So as I said, now we're talking since the recovery, and I promised you'd be on for that. So, what's your general assessment? What's going on? What are you thinking?
Well, I don't know really what you want me to tell you other than the recovery has been engineered. It's not based on any economic data. The stock market is completely separated from the economy as a whole. We're looking at a recovery in stocks because of the action that the Federal Reserve has taken and not due to any type of underlying economic data. And I'm actually bullish on the recovery. I'm bullish on the macro data getting better over the next year, probably quicker and with more gusto than most people think. But having said that, the fact that the S&P is back to 3,200 or 3,300 is not a product of anything that is going on in our economy, and it's completely disconnected from reality for the most part. But that's not to say that I don't think the market can go higher. I think it can. I think that will have no basis in reality. That's why I like to own precious metals as well, because much of what is catalyzing the move here and I don't even know if you want to call it a recovery in stocks, is been the Fed's money printer, and that's it.
Absolutely. I mean, look, this is actually something that I think we've covered a few times already on the show, and I think even a few people here have expressed those similar sentiments. Anybody have want to respond to that?
I think Chris's commentary is very much similar to what we've been talking about over the past 3 or 4 sessions. Various people have contributed virtually along the same lines, with more, maybe even with a little bit more forceful opinion. But Federal Reserve is driving the economy. Not driving the economy, but driving the market.
Yeah. No, I mean, I wish Adrian was here. I think Adrian and Chris would be best friends at this point, based on some
Absolutely.
of the things. In reality,
Yeah.
I mean, Steve.
Well, no, I think then the question it leads to when does this end? And I think that's maybe the more interesting discussion at this point, because we all agree that certain stocks, certain sectors are completely disconnected from reality. And at some point that has to end. At some point, the stock prices themselves start to match the reality of the underlying operations of some of these companies. And in my view, I think when we come up on election time period, closer to the election, when we come with next year's earnings estimates, maybe even going out a couple years when COVID adjusted earnings estimates and things like that are coming out. I think that's when you start to see the reality of the consequences from the last 6 months, whether the COVID continues, how much longer it continues, whether things begin to shut down again or not because of the cases going up again. we'll see. But we've seen this in the retail space already. Today we had another bankruptcy filed in the retail space, and that's going to trickle all the way down to the mall owners, the real estate, the entire sector, and go from there. And so at some point, and it's a matter of when, right? At some point it's going to break, and it'll probably break hard.
Yeah. I mean, who was that? I didn't see. Who went bankrupt today?
Or the market will continue to go up, and the dollar will just turn into fucking Swiss cheese.
Yeah, Ian Taylor went bankrupt. Went bankrupt today. So, this Ian Taylor's a big one because you got 1,100 stores, and so they're in most malls. They're really going to hit some of the the outlet malls and things like that. So, it could, look, it's kind of like, what is it, MMT for stocks or something like that,
Yeah, no, for sure. Yaron, what do you think?
Yeah, I mean, I agree with you guys. There are pockets of the market that are just borderline absurd. I think a lot of them are these low float stocks that appear to be manipulated daily by the Robinhooders. But where I disagree with you is that I don't think the market as a whole is really absurd. I think if you think back to let's go to the last big recession, the 2008 financial crisis, it's clear that stocks were too cheap after that financial crisis because the forward returns of the market over the next, call it 3 or 4 years, were much higher than you would expect on an average year in the stock market. So it typically, stocks should be priced for you to make, I don't know, call it 10% a year. If you're making more than that over a period of time, over a very long period of time, stocks were too cheap at the starting point of that period. And I think the reason why stocks typically get too cheap is because people are worried about the world ending, right? Banks going under, companies not being able to borrow anymore, counterparty risk, consumers all going bankrupt. And so I think when the Fed and just the federal government step in and tell you quicker and quicker each time and tell you we're not going to let this happen, I do think part of it is reflexive, right? Investors are just getting more and more used to it. But part of it is just you're taking that existential risk off the table in a lot of these situations, such that companies are no longer priced on what if they go bankrupt scenario. They're priced on what people believe their fundamentals to be, and they compare what those fundamentals are to what other alternatives they have to invest in at the moment. So currently you have risk-free rate very low. There's nowhere for people to earn any real yield without taking risk. They're going further out on the risk curve. And a lot of very sophisticated investors are saying, okay, if I could buy this company at 25 or 30 times earnings, my current earnings yield implied by that is, I don't know, 3 or 4%. But if I'm very confident this company is going to be able to grow their earnings through cycle at a nice rate, I'm willing to pay that high multiple. I understand that means I'm locking myself in to lower prospective returns, right? Because you don't get multiple expansion on the way out potentially. But where else am I going to earn, 5, 6, 7, 8, 9%? So I'm willing to earn 5, 6, 7 in the stock market. So I do think not the entire stock market is absurd and crazy and Swiss cheese. I do think that there are pockets of the market that are like that, and I do think it gets more and more dangerous the more this mania goes on in those pockets of the market. But I just don't see it as systemic yet. I don't see the NASDAQ at 100 times earnings. I don't see the S&P at 50 times earnings.
Okay, all right. Hold on for 1 second. The Fed is the existential risk. You're saying you don't see any existential risk because the Fed keeps stepping in, but the Fed is the existential risk. And you're talking about making money from an earnings yield, that is essentially nominal. Okay, so you're talking about making money in nominal terms. You're not talking about making money in real terms once we account for the amount of damage that the central bank is doing to the overall economy by the amount of money that it has to print. So the Fed, right? So the Fed is the existential risk. First off, and this idea that 25, 30 times earnings is cheap, like you're talking about, is insane. And with all due respect, I mean, historically, price to earnings ratios of between, maybe 7 and 12 or 7 and 13, depending on what kind of industry you're talking about, whether it's a capital intensive industry like automotives and airlines where, 4, 5, 6 times earnings is very cheap, or you're talking about more everyday industries where, a PE of under 10 is relatively cheap. To come out and make the argument that the market is not absurdly valued right now just goes to show how much the Fed has skewed the perception of the market and the economy right now, because, you're nary going to find a value investor who has been in the game since the 80s or since the 90s, or is a Graham disciple or a Buffett disciple, that's going to tell you that a Schiller PE of 31 is cheap. It's going to tell you that, the market isn't overvalued. And especially when you consider the macroeconomic data right now.
Yeah, I'm not trying to make the argument that stocks are cheap. I'm not trying to make the argument that stocks are cheap, but like even the Oracle of Omaha himself has said, if he knew rates would stay low at these levels for a very long period of time, then stocks are absurdly cheap here at, not that much.
Well, let me tell you something. The Fed has guaranteed that rates are going to stay this low
Yes,
till
I'm
at
not
least
arguing.
2023, and that's what they've said. And Buffett hasn't deployed any capital, so I will let Buffett's cash do the talking.
I'm not going to argue that what the Fed is doing is right. I'm just saying that given what the Fed is doing, I'm not saying stocks are cheap. Cheap means you can make really good returns. I think people aren't thinking, buying Microsoft at these levels that they're going to make really great, 15% IRRs. They're just like, okay, the Fed put me in a situation where I can't even make 4% on, low risk bonds. So I'm okay making 4% in Microsoft. So I'm not saying it's cheap. You're going to make great returns. I just think, and I'm not saying what the Fed is doing is right. I agree with you. The Fed is distorting a lot of asset prices, and, you could make the case for why it's good. You could make the case for why it's bad. I'm not saying what they're doing is good. I'm just saying that a lot of sophisticated investors, given the dilemma of the situation they're in right now, are, consciously going in at these valuations. And I don't think they're being completely irrational given the choices they have to make, because a pension fund cannot go 100% into gold or 100% cash, right? Their liabilities are growing and they have to put money in something that generates a yield and a return.
Well, pension funds can invest in gold and silver.
Yeah, but they can't put 100% of their fund in gold and silver.
No, they can't, but they can take a sizable position.
And that's why silver is going up 10% a day right now.
I agree. All right, so we're on the same page.
We are.
All right. Well, I mean, I think instead of quoting Buffett from here on out, we're only allowed to quote Davey Day Trader, because that's the kind of market that we're in here. When do you think inflation comes back, Chris?
Well, inflation is happening, right? So everybody is misconstruing inflation as what the PCE number is or what the core CPI number is. But really, inflation is just the addition to the money supply, which has been happening. If you look at the M2 money supply, I mean, it's up something like 23% year over year right now over the last quarter, which is an absurd amount. So that money, and the argument is going to be a kind of a velocity of money argument. Well, it's all kind of parked in super secret Goldman Sachs accounts and it hasn't come out, and, people haven't used the $5 trillion to buy loaves of bread yet. So we're not seeing a run up in consumer prices, but that's a foregone conclusion. It's going to happen at some point, and it's going to happen relatively soon. The money is out there now. So if you look at inflation in terms of the expansion of the money supply, we're watching it happen right before our eyes. And, the sad thing is when it shows up in consumer prices, a lot of people are going to be acting very surprised. But it's a foregone conclusion.
Yeah. I mean, I agree with you. I think the $1 million question is when it starts to show up, though, in kind of day-to-day life here. And given COVID, it's probably been, I don't know. You look at things like real estate, look at other plays. I mean, I'm not into the precious metals like you guys are, but if I wanted to invest along this thesis that inflation was going to come back and come back hard, I would look at real estate, and that's not an area I can, would want to look at this point, given the COVID crisis. So it's a tough
Well,
decision.
it's about trying to find real returns and not nominal returns when you're talking about, which asset class is going to inflate the most and then trying to kind of get ahead of that. I mean, real estate has its risks too, especially commercial real estate, where all of these businesses now are basically adopting a work-at-home model that really looks like it's going to be semi-permanent for a lot of these companies. So, it's about finding real returns, right? Not nominal returns.
Yeah.
And I mean, COVID, I agree long-term what the Fed is doing right now is inflationary, but in the near term, COVID is very deflationary to the world. So timing when those kind of two lines cross is a very difficult thing to do. I mean,
Kevin, what do you think? Have you got any thoughts on what's going on here?
Actually, I'm very interested just listening to what's going on right now. And all three speakers have obviously been engaged in this conversation or doing research in it for quite some time. And I think that the commentary about when is it going to happen is quite the interesting thing. And you just shrug my shoulders and sit down and say, who the hell knows? I mean, ultimately, I don't even know whether there are metrics to be followed. Are there metrics, or are there performance indicators or any sort of indicators that would be referenced at this point in time to give anybody an idea? And I don't know. I mean, is there, what are we looking at? I mean, I'm looking at technical analysis, and what I'm looking at is some of the stock prices are so far above their standard deviations right now that it's getting really spooky again. So when you compare the Qs, against what happened back in March, you're looking at the same thing from a technical perspective. And Bobby and I have had this conversation. I follow the technicals because I think it interprets the sentiment. I think that when people who are having these conversations make their decisions about when to deploy funds or when to go to cash, that sentiment is markedly shown in the charts, in the technical portion of the chart. So unless there are macro indicators of some sort, of micro indicators of other sorts, I'm just watching the technical part of charts in the markets just to see whether or not there's anything that can be interpreted that way.
Well, historically, there's no precedent for what we're doing right now. So it's
Agreed.
extraordinarily difficult to try to figure out what the leading indicator is going to be right now, right? Like if you ask somebody like me, I'm a hard money guy, so I'm going to tell you M2 is the leading indicator because that tells me everything I need to know. It tells me the money's out there. It's just not being moved around in the right way, or it just hasn't hit the right asset class yet or whatever. So when it comes to a question of trying to figure out like what the canary in the coal mine is going to be, right. It's really difficult, but there's nothing that is going to, if we woke up tomorrow morning and gold was up 10%, right, which would be, let's say gold's up $200 an ounce tomorrow morning, or if 12 months from now, CPI is at 5% or 6%, would it surprise anybody? And the answer is no. I mean, we all kind of are on notice that it seems like this inevitability. I mean, even after 2008, we printed all this money and everybody says, well, we never really got the inflation that everybody was talking about, which is total bullshit. The inflation just showed up in different places. And also, too, if you look at a basket of normal individual consumer goods versus what the Fed is using for the CPI, it becomes very evident that inflation is, listen, I'm at a tiki bar right now, okay? I just paid $14 for a drink, all right? Now, listen, I'm on a beach, okay, so I expect to pay a little bit more, but $14 we're talking about, all right? I paid $7.50 for my coffee this morning. Yeah, well, I tell you what, man, in this, shithole beach that I'm at right now, it's a little expensive for here. This is a place I come to all the time, so I'm familiar with the prices. The point is, if gold goes, if we wake up and gold's at 2,500 tomorrow, it makes a historic 40% move. Or if you show up at the supermarket in 12 months from now and a gallon of milk is $8.99 or $9.99, it's not going to surprise anybody. And it's, as I said before, it's a foregone conclusion. But we are embarking on an unprecedented, what we're doing right now is unprecedented. We've never done it before. So it's very difficult to try to forecast when and how these things are going to take place.
I mean,
the only
again,
certainty is that they're going to take place.
I agree with you that what the Fed is doing it introduces the risk of that type of inflation. It's just when you see headlines like the one of United Airlines today saying they're overstaffed by 20,000 people, and all these companies that are looking to, let people now work from home, so they want to cancel leases on their office space, and you hear of all these auto manufacturers or aero, players. They're all like, a lot of people are cutting jobs. And when you have people cutting jobs, I think that's massively deflationary to the economy. And the government giving those people now money to go out and buy what they would have bought if they just got their paycheck is not as inflationary as if they just handed people that money when they already had the job that they had.
Well, think about the three biggest drivers, right, in the last maybe 20 years for inflation. You have higher education, right? You have healthcare, you have real estate. And in this environment today, each of those three things are kind of in deflationary situations almost, given the COVID crisis and maybe what the ramifications will be over the next year or two. And those are kind of the three biggest drivers there that aren't.
You think healthcare and education are experiencing deflation right now?
Well, higher education is certainly going to be in a unique situation over the next year. I think there's going to be a significant demand drop there. And, healthcare with all of the kind of telemedicine things. I mean, look, I haven't gone into the doctor recently, but I've had like a virtual, video meeting with the doctor and things like that. And those types of things, I think the rate of their historic inflation was extreme, and it's not going to be possible for that to continue going forward. And in some cases, it may be flat. And in higher education, I think a bubble's about to burst over the next few years.
Well, I think part of this also depends on what you think, how you think we'll deal with COVID going forward and how big of an impact that's going to be. Now, I personally think that probably within 6 months, I would say COVID is going to be a total afterthought. And what I mean by that is we will have a therapeutic, we will have more than one vaccine, and we will think of getting a COVID shot every year the same way we think of getting our flu shot. And we'll know it's out there. I don't think it's going away. But I think once we get some more robust data, it's going to be very clear that COVID is not as absolutely lethal as we thought that it was at the beginning, and nobody was advocating to take caution more than I was in January. But seeing the data that we have now, seeing the amount of asymptomatic cases we have, seeing what the reasonable case fatality rate is now, I think that we're going to experience probably a quicker recovery than most people think. The question of higher education and healthcare, I still think people are going to have to go to their doctors in person. I think telemedicine will play a part, so I think you make a very good point there. But I'm not sure that it's going to be profound enough to cause the deflation that you're talking about. I also think that higher education, which is basically subsidized by the government, who puts together these student loans now. I mean, the government is in charge of basically subsidizing higher education, which is what enables the colleges and universities to charge a shitload of money. I think all this is going to do is enable them to charge more money to do less under the guise of, hey, we're providing you with the stay-at-home option now. So instead of lowering our faculty to student ratio, which we've been doing because the checks have been coming in guaranteed from the government, we're going to make it even better for us because now everything will be done online. So now maybe we can go 50 students to one faculty member. So I'm not sure that'll cause the type of deflation that you're talking about. But again, a lot of it hinges on what you think how quickly you think we'll recover from COVID and whether you think there'll be profound effects or not.
I mean, education, healthcare, and real estate, I agree those are the inflationary drivers, but those are really the three big areas of spend that we, are pretty much forced to spend money on in today's society. And B, they operate in a cartel-like fashion. Like the top universities, like they name their price and you kind of have to go, and they all it's an oligopoly, right? There's only like so many of them. They're capacity constrained. It's not really exposed to free markets. And then on top of that, you have the government lending people money, as much money as they need to go to these schools. So like if, you know, the good schools raise their price 15% a year, the government will just lend the students 15% a year more. So they have unlimited pricing power. So that makes sense why that's been inflationary. Healthcare, there's limited capacity for, I mean, it's very cartel-like. There's limited capacity of physicians in this country. You have like all the pharma and device companies, they have patents and they could charge whatever they want, and you can't, it's not really a discretionary area to spend. And then real estate, like you have to live somewhere, and typically you have to live within a certain distance of your work. And there's only a certain amount of apartments or houses within a certain reasonable distance from, you know, where people live. And so like, it makes sense why those have been inflationary. Also with real estate, like interest rates going down for such a long period of time has made affordability of purchasing, you know, it's pushed the valuations of real estate higher as well. So that makes sense. But like all the other areas where I spend money, other than those three, where like they're more subject to like free market, right? Like if you're buying a car, if you're buying food, like anytime any of these companies earn slightly above their cost of capital, like new supply is added on, and then their margins get compressed again until they earn slightly below their cost of capital, and then people stop adding new capacity. And I think like, and then on top of that, you have all this technology, which like Google search is something I get for free, Google Maps, something I get for free, all this stuff that like has added tremendous value to my life that I'm not paying for. That's been deflationary. So like, I'm not so convinced that like all the other areas where I spend money other than those three are gonna like magically become super inflationary overnight.
But the inflation comes from the money printing, right? The inflation doesn't come from the rise in prices. The inflation is the addition of new money to the money supply, which dilutes the purchasing power of the money that's already in existence.
Right.
And it doesn't matter whether that shows up in pineapples or it shows up in lacrosse sticks. The fact of the matter is the money has been printed. The purchasing power of the money in supply already is diluted, and that's where the inflation takes place. It doesn't take place when, you know, Goldman frees up a $1 trillion account that it got from the discount window from the Fed and puts it all into milk.
Well, inflation really only happens when demand exceeds supply of something, right? Like if there's only like 4 cartons of milk in the store, it's actually true. Like think about when people are able to raise prices on you, because if there's an abundance of something and someone tries to raise the price on you just because they know you have more money, you're going to go across the street and buy it at the other store, and there's competition. So like they're going to be competing. Those sellers of that product are going to be competing against each other on price. So really the only time they could actually jack the price on you and make it stick is if there's not enough supply of something. So typically if you print money and give people more and more money and they go out and buy more and more stuff such that there's not enough stuff out there for everyone to buy, they'll bid up, right? They have the extra money, they'll go and bid stuff up. But like that you have to have capacity constraints in the things people are trying to buy for that. That's the only way the price is bid up.
It's less about the price. It's less about the price of products and services, and it's more about the amount of supply of money.
Okay.
Can I jump in?
Yeah.
One of the things that were mentioned is the issues of higher education and healthcare. The one thing that I've been looking at recently is this whole idea of dispersion and how people are seemingly beginning to leave these high density areas like LA, San Francisco, Boston, Philadelphia, et cetera, and are moving away because they know that they can work from home. One of the things that I've been looking at is all of a sudden housing prices in Montana have begun to rise rapidly, okay? With a lot of the money coming from these highly paid jobs in in these urban areas. A couple of things I was looking at is what is the dispersion going to do? How does it create opportunity? Again, in the real estate, if you look at real estate or telemedicine. And similarly, what happens when the well-paid jobs are maintained at those high price levels, and how does that affect the economies of some state like Montana, in which they don't really have a high-tech industry, yet they may very well be receiving one during this dispersion of people as
Right.
they move around the country. So with dispersion, I think you upset just about everything. Certainly you can upset real estate again. Certainly you're going to sit down and look at healthcare. A kid from Google who's living in Montana is going to demand that he has high-priced, high-quality medicine, and that's going to drive telemedicine. And the other thing about it is that I've been watching the education bubble for 10 years. I thought it was going to collapse a long time ago. But here we go again and again and again. What you find is that young men and women are coming out of school with degrees and end up being contractors or bartenders or something like that. So,
Right.
The capacity of being able to create or generate a return from those money spent in education is becoming shit. Excuse me, Bobby. But
Correct.
that's one of those. So, there's a lot of
I
things
agree.
that are being wrapped up here with regard to shifting protocols that otherwise might never have occurred if they weren't for this COVID thing. So I'm very
think you're
interested in
making-
people talking about dispersion.
I think you're making a really good point about an exodus that is already happening from cities. And I think there's a couple of things going on, right? The first is people don't want to be in cities because of the virus. Obviously, cities are densely populated. People are close to each other. All of my friends that live in New York City, the first thing they said in 3 months ago when this became a big deal was, how do I get the fuck out of the city? Where do I go? Do I go to Westchester? Do I go to Connecticut? Do I, move to the Sahara Desert? How the hell do I get away from people, right? So that's one thing. We're going to see a natural kind of exodus from cities due to that. The second thing is that with employment, a lot of people move to cities because their jobs are in cities. That's one of the main attractions. It's the main, one of the big forms of gravity that pulls people into places like New York and London. Nobody goes to these places because they think it would be fucking fantastic to spend $16 for a pint of beer. People go there because their job is there. They move to New York City and they hope that they can earn a wage that barely allows them to afford to live in New York City. And as anybody that's ever gone through that knows, when you first start doing that, you definitely don't earn enough to do that. And the cities, the cost of living in these cities is extraordinary. But part of the reason that they can maintain that is because they continue to kind of have this funnel into these major cities due to employment opportunities. So those will go away too as more and more people transition to work at home. And there's been all of these companies that we've seen that have said, we're maybe not 100%, but we're going to make 30% of our workforce work at home now permanently, 40% permanently. It saves the companies cost, which is fantastic. They don't have to buy the commercial real estate. And it saves people the fucking headache of moving there, which is why you're seeing apartment prices in places like Manhattan collapse near where there are these giant, very well-known commercial office spaces and these giant skyscrapers that have these enormous businesses in them because people are getting away from them. In addition to that, you have liberal politicians, not to make this a political discussion, I'm just making a statement of fact here. You have liberal politicians in many of these cities that want to raise taxes, okay, and lower the amount of law and order in these jurisdictions. So New York is a perfect example. We have Bill de Blasio. He fucking couldn't hit sand if he fell off a camel, all right? He wants to defund the police department, and he wants to, New York's talking about now implementing a tax on stock trades. They're talking about. They want to tax a penny, I think, on stocks under $5 that you trade per share, and 5 cents per share on stocks, I think, that are over $20 a share, which is insane, okay? And what you're going to see with all of those things combined, and that's also, Bobby, for places like California too, man, where they're running these huge deficits. You know, you have people shitting on the streets in San Francisco, and you have liberal politicians unable to understand, with a tax rate of, 90% or whatever the hell it is in San Francisco, why they don't have enough money to fix the problems, because they don't understand that the solution is less government, okay, and not more government. So you're going to see this mass exodus out of places like New York City, out of places like California, and people are going to go to Texas. People are going to go to Florida. They're going to go to Puerto Rico. They're going to go to places where the taxes are low, where it's easier to do business, where there's law and order. So sorry to go on a bit here, but it's about, not just the effects of COVID on the cities, but the effects of, taxes going up in major cities too. We're going to see a huge exit. If I could figure out a way to get a pure play short exposure just on citywide real estate, I would pound that right now. I think that is the trade.
Yep. What I'm also saying the same thing is that you're going to be a huge benefit when you're a non-tax state. I mean, Wyoming is certainly
right.
one. It's also a great place to get. And the other thing that's happening is that connectivity. I'm out in Breckenridge, Colorado, and they're putting in fiber optics into Breckenridge, which is a lovely place to stay. There's no industry to speak of out here other than tourism. But I can sit here and trade. I can sit here and I can do a lot of different things because I have a great Wi-Fi. So again, there are draws that are compelling people to leave these places because the services that you're getting are comparable in some fashion, comparable to the point where they keep you connected. But at the same time is that the quality of life versus the quality of life in some of these situations is far superior. I will only make one comment. The one thing that exists that is of value to me in any sort of urban environment or highly institutionalized environments, things of that type, is the value of networking and the value of connectivity of people.
Sure.
Let's face it, when you go to an Ivy League school, you don't go there just to get an education. You go there because all of the highbrow MBAs or commodities places are going to be the captains of industry. I want to know who the hell they are so that when I start doing my deals, I'm very, very well connected already. So I don't think that's going to go away at all. I know for a fact that if I'm a Harvard Business School guy, I want to know who all my friends are, who the alumni are, and that I'm capable of being able to call them up, instantaneously for any sort of contribution I'm asking them for. So I think that there's good news and bad news on this dispersion thing.
As a non-Ivy Leaguer, tear down that stigma. Tear it down already. It's antiquated.
I actually staring at them all the time. I mean, being a Bostonian, it's you kind of living in the pit of it. But I'm saying there's good news and bad news about dispersion and exodus of individuals from these areas. But the other thing about it is if you pass this thing out 20 years from now, it'd be fascinating to find out, because what it suggests homogenization in some fashion of communities around particular areas. I mean, homogenization of technology. The Google guys and Google gals right now are pretty much in the urban environment, but one of the kids that I know, he's 30 years old, MIT grad, he's living up in northern Vermont, okay, making his ton of money that he's going to be paid anyway in Boston, but he's living in Vermont. What's that going to do to the Vermont economy? And this is way up in the Northeast Kingdom. If all of his friends start to move up there and they begin to bring the attitudes and expectations arriving from living in the Boston area or living in LA or whatever, how does that impact long-term contributions in society? So again, I'm very, very interested in seeing what's going on in the democratization of this type of stuff. I mean, if you look at it, from a demographics, what I mean by democratization is demographics, not politics. Again, how is this all going to fare out? And is this COVID thing really going to have a long-term dramatic impact upon the way in which cultures are going to be operating?
I'll pose a question to you guys. maybe we are seeing all this money supply cause inflation, but we're seeing it in asset prices, right? Like, why would you be surprised?
Of course.
Yeah. So, but like, if gold tripled in the next 6 months, none of us would be surprised. Like you said, if gold went parabolic, wouldn't be surprised. And I personally wouldn't be surprised if like the value of NFL teams went up 3x, NBA teams.
Oh, and how about art, Bobby? How about
Art.
these fucking piles of shit on Canvas that people are trading with each other for, $1 billion each? Oh,
Exactly.
this was drawn by fucking so-and-so in the year 1806. Oh, okay. How about, I don't know, $157 million for that? Yeah, great. Let me just hang that on my wall. Like, are you kidding me? Are you insane?
Right.
Like,
So
we're
maybe
seeing
that's
it
what's
in all
happening
these
with all these story
Sotheby's-
stocks. All these story stocks
Sotheby's-
with limited float, you know?
Sotheby's did a Scotch auction, all right, Bobby, like a year ago,
Oh,
where
Chris,
they were auctioning off.
that was your own
some-
talk. I can't take credit for what your own saying.
I don't give a shit. Whatever.
All right.
The point is, Sotheby's auctioned off some fucking old fuck who died Scotch collection, all right, from like the 1600s or the Mesozoic era or something. Who cares? But the point is, somebody came in and bid like $60 million for this guy's Scotch collection. Okay, I walk across the street right now for $100. I can walk out with at least 5 or 6 bottles of Scotch that tastes mostly like paint thinner, but it's gonna do the trick. There's somebody right now in an auction house that has so much money, all right? There's so much money being distributed to this person one way or another. It is coming out of their eyeballs and their asshole so much that they can't think of anything else to do but to fork over $60 million for a Scotch collection, okay? And then people are like, oh, where's the inflation? Where's the inflation? Some guy just fucking charged $120,000 for a banana duct taped to a wall in an art museum. And people are asking where the inflation is. I mean, it's absolutely insane.
But if
And
it
let's
stays,
talk about
if
commodities.
it stays in all
real
those
quick.
areas, who cares? Man,
Well, yeah, but it's out there. The point is, the money is out there. All right. When the Fed prints $5 trillion for this CARES Act, all right, and then throws everybody a breadcrumb to the tune of $1,200 per person after they have printed $50,000 per U.S. citizen. All right, and everybody knows, while every U.S. citizen is bearing the brunt of $50,000 per person in inflation, they haven't gotten $50,000 worth of benefits at all, anywhere close to that. They've probably gotten 5% of that. But the rest of that money is out there. It's out there somewhere. And that's, walk into a Sotheby's if you want to see, people with more money than they know what to do with, spending it on shit that if the 3 or 4 of us ever turned out to be billionaires, we would never in a million years buy. We would just be driving around in our Hondas like normal, and we would just have some extra money in the bank. But the money is out there. The last thing I'm going to say real quick, then I'm going to let everybody go because I hate monopolizing the conversation, but after I've had a couple of cocktails, that's how it works. Let's talk about commodities real quick, all right? Right now, I'm on a beach, all right? Before, when my friend was talking about dispersion and making very good points, I put the phone on mute. All right. While the phone was on mute, I asked the person behind the bar to take a whole coconut and saw it in half. And when they did that, I asked them to fill one half of the coconut with rum and then hand it to me. And they did that. So that's my whole thesis on commodities. It's been very nice talking to you guys. Bobby Kraft, I love you. I'm going to give you a big kiss when I see you.
See you later, buddy. It's Chris Irons. Everybody.
So that was fun.
Oh yeah. No, we're still going. I mean, look, I think, one to just hit on one point that Chris was making about, going to other cities, it's at least, look, for me, it's not so much about law and order. There's always going to be some sort of police presence and making sure everything is running smoothly, and it should get better, of course. We're having a big problem with police brutality right now. I think we can all agree. But at the end of the day, when I'm thinking just quality of life, honestly, I mean, look, I've been in LA more than half my life, and then in New York for the other bit. We got 2 New Yorkers on here, and then Kevin in Breckenridge, Boston, whatever. I intentionally ignore that.
B for Breckenridge.
Yeah, B is for Breckenridge. That's right. you know, but at the end of the day, that's when you start thinking to yourself, like, okay, I surf how many days a week? All right, let me put that calculation into play of like, am I really missing out on doing my favorite hobby because I'm only doing it less now and sacrificing that to then move somewhere more inland where my dollar will go much farther? You know, like amongst my friends and people we talk to, especially in LA, that are we're all on the same kind of economic scale. That's really the question that we ask ourselves. It's not so much of like, you know, is it a great place to live? Of course, LA and New York are great places to live. Like, you know, there's a lot going on right now because there's a lot of civil unrest. But to make the argument in general that they're not great, and that's not what Chris was saying, but they are great places to live. So it's just it's really trying to put that equation together, you know? That was my piece.
Interesting half argument, Bobby.
Oh, thank you. I appreciate that.
No, it's true though. There's a reason why, you know, taxes can be higher in certain places because people are not as willing to move out of those areas. And, you know, that allows people are willing to pay higher taxes, even if they're not getting a commensurate return on that quote unquote investment into the government because they can live by the water. You know, look, California and the beaches and San Francisco and things like that are great places to live. Set aside maybe some of the civil unrest and homelessness and things like that, but there's a reason why people love to live there. Same thing with New York. And, you know, to Kevin's point earlier, yeah, maybe, you know, you go to visit Montana or Wyoming or something like that, but I want to order sushi, you know, and have it delivered to my apartment and have it be great. And I can do that here in 20 minutes.
I can do that. I can do that here in Breckenridge instantaneously. Or if you wanted, to
25 options though.
Well,
no, not to say that it's an absolute thing, but look, you've got culture in certain of these cities that can't be replicated elsewhere. And there is a reason why people love to live here. And, you know, there is a tipping point at some point with taxes and with maybe some unrest. But ultimately, you know, I would say I'm long-term bullish on great cities.
But I mean, short term, what's happening from, you know, it's in cases you see it already in Harvard where the kids don't want to pay $50,000 to be trained on a monitor. The other thing I'm seeing is municipalities are getting a lot of pressure right now because the kids aren't going to school, so people want their taxes back. Okay, because what are taxes used for? Schools, police, fire, and a few other things. Okay,
yeah, so
and
if we defund the police, we don't have school. There's probably maybe more fires because people are at home more.
Yeah, well, but again, if there's no services being provided, and I'm supposedly paying taxes for these things, you're starting to read about it. Okay, I do think that it's going to be short-lived, but I do think that it's going to be something that's going to be seen more and more and more if this stuff continues. I mean, I think people will take it for a little while, but if for example, some municipality cancels all schools for next year, I mean, the impact of that is going to be crazy. I mean, again, it's wait a minute, I'm paying for this.
I do not envy any seniors at all, either seniors in high school or like about to start their first year in university. I really do not envy.
How about seniors like me who have to pay the taxes to not get any benefit from the schools?
It's interesting. I saw somebody tweet that the other day, and I thought that was an interesting argument. It's like, because on one hand, we all agree that, you know, we want to trust our institutions to make sure that everything is, you know, they're all following the health guidelines and everything like that. But at the same time, it's like, okay, well, especially in places like California and New York, where really high tax rates, you're like, okay, well, all right, if school's not going to happen, like what do we do here? Like how do we figure this situation out? You know, and not only that, like you still want to make sure our teachers are compensated. You know, I think we can all agree at the same time that you don't want to see teachers get their pay cut just because now school went online as well. So it's like how do you, I don't know. I'm not smart enough to really put that equation together, but I will say one last thing I see, at least for me personally, I see the unrest. It's almost a necessary evil right now. I think there's a lot of things that, you know, do need to be, you know, I think some of these protests are definitely warranted. but I do hope we see some actionable change so that protests don't need to keep happening, because from a safety perspective, I think we want to see that, if that was ever even a percentage cause of some cases, we want to see some answers happen there so that, at least cases do go down in that sense. But I digress. I think I want to get on to the next topic. I don't mean to close it off, but there is 2 other topics that I wanted to get to today. And that's talking about SPACs. It's gotten some news. SPAC, it's been in the news a bit. It's been talked about a lot. Special Acquisition Corporation. I'd say Yaron, we were direct messaging about this a little bit earlier. So you want to kick us off here?
Yeah. So SPACs, they stand for Special Purpose Acquisition Corporations. And basically what they are is they're these blank check companies that are raised by like a sponsor, usually either a private equity sponsor or a hedge fund sponsor, or just someone who is known as a business person or something like that. And they basically go out to investors and say, hey, you guys should buy shares in my SPAC to help me fund the SPAC bank account with cash. And I'm going to go find a great acquisition target for our SPAC to buy. But don't worry, like you're going to get to vote on anything I bring forward before I complete any acquisition. Like you'll get to vote. And if you don't like the deal, you'll get your cash back plus interest. Now, the investors who agree to that, who decide to fund the SPAC, those typically aren't really like fundamental investors, right? Because what are you investing in? You're investing in a shell company that's going to own cash, and you don't even know what that shell company is going to buy, so there's nothing to analyze. So you're not really a fundamental investor if you're buying the shares in the SPAC. You don't really care what the sponsor is going to buy or how much he pays for it, as long as you could flip it to the next guy. So you're trusting that that person is going to be able to market the deal that they do to other investors. And those initial funders of the SPAC, their intention is never to even vote yes for a deal. Like if a sponsor brings a deal to them and they can't sell their shares to someone else for a higher price before it closes, they'll basically just vote no for the deal. They'll say, I want my cash back, and then the transaction will never close. So those guys, the initial purchasers of those SPACs, they're not fundamental buyers. They're doing it because they want to flip the shares, right? And so then you're like, okay, so what are they in for? Like, they don't want to just buy these shares for $10 and then sell them for $10.50. Like, you're not going to lock up your money for 2 years. Why are they doing this? Why are the sponsors doing it? And the sponsors are doing it for one reason. It's very clear. They get fees in the form of economics in the transaction they bring about. So they get paid very, very handsomely for the deals they do. And the people who buy the initial shares in the SPAC, they get warrants on whatever ends up being bought down the line. They get to keep these warrants on that acquisition. So like if it's a really hot deal, they get to keep the warrants. Before the deal closes, they try to like flip those shares to more fundamental buyers who like analyze the target and decide whether they think the story is sexy or not, and whether they want to, pay. If the SPAC was done at $10, then the initial buyers of the SPAC are willing to sell it for 10 and a quarter, 10.50, whatever. They just make 25 or 50 cents. Then they get to keep the warrants that they could either sell down the line or sit on if they like the deal. And so that's what the buyers of the initial SPAC get and the sponsor gets. Now, the companies that decide to sell to the SPAC, what do they get, right? They get to, a lot of people who raise these SPACs say, okay, you can avoid coming public through the traditional IPO route, which requires, a lot of planning and road shows and big IPO fees. But in reality, that they're still paying fees to the sponsor. They're still doing road shows because they have to go and market the deal to the fundamental buyers. Because like I just touched on, if fundamental buyers don't step up and buy the SPAC shares from the initial SPAC funders, the transaction won't close. So the management team still needs to go out. They put together these long decks and presentations, and they go to Boston and they go to New York and they go to California, and they try to meet with as many investors to convince them that they should be buying these SPAC shares and voting yes for the deal. So they don't really get to avoid this IPO process. So like you have this thing that's pitched as a great deal for so many people, and in reality, it's historically just been a great deal for the initial SPAC buyers, not the fundamental buyers who buy the shares from them. and the sponsors who make a tremendous amount of fees. And if you go back and look at the historical performance of SPACs post-transaction, they haven't done very well at all. And it kind of makes sense because like the sponsor just wants to get any deal done in their 2-year window because they get paid fees only if the deal closes. They're willing to to pay up a lot of times. And the people who are selling the business to the SPAC, they're like, okay, if you're willing to overpay me for it and I still get to retain my job in the management position, like fine, I'm in. And so they historically haven't performed very well. Lately, they have been performing extraordinarily well. And a lot of the SPAC sponsors have figured out that if you buy these like high flyer, super rapid growth companies that retail investors are attached to, there's a low float and there's a lot of demand for these shares, the stocks just go parabolic. And there's a handful of examples of SPACs that have literally, like, from the moment the transaction closed until a month later, they've just gone parabolic. I don't know that this is going to end particularly well. Like, the SPAC sponsors are seeing all this demand and they're getting more and more aggressive with the sizes of the SPACs they're trying to raise. And so, like, I'm just curious to hear your guys' thoughts of, like, whether you think this is going to end well. I don't personally. And what's driving this mania in SPACs?
Let me just sit down and tell you that everything that you've outlined, I think, is on the money, quite well outlined. And to me, SPACs are shysters promoting amateurs crap. Okay, I've seen the same thing. I think some of the electric vehicle companies that have been really hot these days. I think there's one of them that went SPAC. I forget which one it was.
Nikola, yeah.
Was it Neo or something?
Nikola.
I forget. Which one?
It's basically like Tesla times 100.
Yeah. So you're absolutely
Steven,
correct.
do you own it? You mentioned it. You have to say if you own it now.
I do not own it.
Yeah. So I think you're correct. You're on about the whole thing. Is, I mean, you look at it and you go, I just keep shaking my head. No. This is not going to end well for anybody. Okay, it's going to only end up well for the shysters. They'll make some money. They'll do the deals, and it's just to me, it's just a public way of being able to bring private deals, that make them even more money. Again, I mean, we're all familiar with financiers and so-called investors. Their job is to make money. All right, whether or not it's Goldman Sachs or whether or not it's a microcap investor or whatever it is.
Yeah, they're really schemes. It seems like it's a scheme between the IPO underwriter, the SPAC sponsor, the people who are selling the business into the SPAC at a lot of times an elevated valuation, and the initial funders of the SPAC who get these warrants basically for free. And then the people who are left on the hook are like the people who actually buy the SPAC shares because they watch these investor presentations and they're like, wow, this story is awesome. And like, look, there have been some successful ones. There have been more than a handful of them. But in general, it just seems like a great way to, like, for sophisticated people to take advantage of less sophisticated people.
100% agreed. And not only that, but the funny thing is that I think it's selling, particularly, of course, if they are NASDAQ or New York exchanged, because they can shyster up to the Robin Hooders. And I think that is probably part and parcel of it. Is it's a great way of being able to suck in tons of retail, unsophisticated, if we want to sit down and say that Robin Hood is unsophisticated, and in some fashion. I mean, it's just, I forget, as I said, I've seen a few of them, and like they go from $1 to $14 within literally a couple of days.
How'd you like to own the sponsor? So there's one that popped up just a few days ago that I own. Is a company called Pendrell, which trades at about $150,000 a share, and I own it and have owned it for quite some time. They are sponsoring a new SPAC. They're trying to raise $250 million. It's called Holicity, HOLICITY. And for Pendrell as the sponsor, this is a good way to, as an example to what Yaron, kind of spoke of how these things are designed. Pendrell is the sponsor. They put up $25,000. They get 20% of the company. So if they raise $250 million, Pendrell turns that $25,000 into $50 million. right? So you want to be, typically want to be on that side. You want to be on the sponsor side. And here you're able to buy it if you, want to spend $150,000 per share for the Pendrell shares if this goes through. So,
it just reminds me of housing derivatives.
Yeah.
I mean, it's, when something smells like this, I mean, it's, you got to have a bad nose not to be able to understand what's going on. I mean, it just seems too blatant in my opinion. Again, I'm unsophisticated, so I just see what's.
Well, it's a way for some of these companies to go public in an environment today that's a little bit more difficult to do so. That's why Nicola and a few others have done that. That's actually why they probably performed well here, as Yaron spoken.
So the interesting thing is that this is comparable to the Canadian market, CSE, okay? Because CSE was set up almost exclusively to bring weed companies to the market for any number of reasons that had to do with cash and transactions of cash and things of that type. So they had to set up a separate market. CSE is the thing. And the other thing about it is that if you're a Canadian company, they all try to avoid, even a lot of American companies go to the Canadian marketplace so that they can get to the market faster, non-IPO, save money, and all these different things. Same kind of argument. And they're just called shell companies. I mean, they're mostly old mining companies that are still around. They're still kicking and screaming. Somebody owns them, and all they're going to do is they're going to blend this new company into the old shell. And the guys who own the shell, take out a big hunk of what's going on. It's the same kind of deal. These SPACs are in fact shells. Okay, whether they're well-run shells or whatever, they're just a shell company that's going to go out and do something. And oh, by the way, we're all going to make ourselves rich. Similarly, I forget that there's another means of doing the same thing. And shells can be extraordinarily bad because they have massive skeletons associated with an operating company in the mining business, which of course is sketchy to begin with. And there's another way that it's done in Canada. And again, I forget the phrase, and I'll have to look at it, but it has the same kind of thing is that 3 or 4 guys, maybe a hedge guy, maybe people from a Canaccord will set up this something company. They'll set it up for $250,000, which I think is the going in price. They'll get a company. They'll have the company assigned to them, and they sit on 1 million shares at a penny. And then they bring this company public at $2. Thank you very much if you can do it, okay? I mean, some of these things are pretty astonishing. Some of the terms and conditions absolutely suck. And some of the terms and conditions are actually well done. But again, I have to go back and find out what the name of this alternative is. It's the non-skeleton way of being able to take a shell company and that merge your company into that shell company. And again, I forget what it is, but it sounds exactly the same. I mean, shell companies in Canada, the IPOs, they're reverse mergers, the reverse IPOs, they get public, and I've never seen a lot of them work very well. And that's one of the reasons why when this whole SPAC thing came out, shysters promoting amateurs crap. And it's the same kind of thing. So I've seen it before. And
yeah, that's where there's potentially an opportunity though, because in general, that's what it is. But as an individual investor, if you can find an exception to the rule, if there's a company that's acquired, brought public through that process, or bought into, to be brought public, 1 out of maybe 10 or 15 or 20 might be an opportunity because it's a baby thrown out with the bathwater type of situation. So it's worth looking at as an individual investor.
Look, the Burger King parent, the parent company of Burger King, Restaurant Brands, which I do own, they came public through a SPAC. It's probably one of the most successful SPAC deals of all time. And so I agree, like they're not all broken, but in general, when you see like more and more people piling into this trade on the sponsor side, and they're trying to raise bigger and bigger pools of capital, because they see what's working in the retail environment, and then they go out and like buy these things that they think will resonate well with retail investors. It's just, I don't know, doing so well with me.
Again, if you go into one of these things and management has their, as you just said, Restaurant Brands, if the management walks in and their eyes are wide open and they know the game and they're sophisticated players and they have sophisticated capital markets people, working with them, then I think it can work. However, many of these companies do not have sophisticated capital markets expertise. They're just going in because it's cheap. You know, it was made, you know, again, I'm looking at microcaps rather than something that's significantly large. If a company's already doing well, they're private and they want to go some other, they could very well be a substantial good candidate, okay, when they already have a developed revenue stream, they already have a developed management team, and they have a very, very sophisticated means of being able to reach out to the capital markets, okay? So I wouldn't disagree that there are opportunities, but I think that the opportunities are probably much more well-defined than not. I mean, again, if you're going in wide open with a good approach, again, whatever the hell that means, you
Kevin,
probably can do very well.
Hey, what would you guys say is some criteria for a successful SPAC? I mean, like you said, 1 in 10, 15 might actually be decent, you know, and I think we can all agree there's so many of these gem of microcaps that you ask them all the time. They're like,
the question
how'd you become public? Why are you public? And they're like, the former management just did a reverse merger.
The question you have to ask, Bobby, is a SPAC a means of being able to run a venture capital business, okay, with retail money rather than going out and finding money. So if you're a venture capital guy, you have to go out and find 500 million, okay, and do 10 deals and one works. That's what you're saying is if the SPAC only makes 1 in 10, then it's the same thing as the venture capital return on investment. So what's the SPAC doing that's different from typical venture capital? It's bringing the venture capital to retail.
Right.
Is that Yaron? Would you agree to that?
Yeah, it's very easy to raise a SPAC because the people who fund the SPAC initially have caught on to this trade where it is effectively riskless to them. Like the only risk they really take is that the money, basically they fund the SPAC, let's say with 100, 200, 300, 500, $1 billion. That cash then sits in a trust at some custodian bank, and the sponsor can never touch the cash until they bring the deal to the SPAC sponsors, and the SPAC sponsors have to vote in favor of the deal. Otherwise, it's just accruing interest with treasury bonds or your treasury notes, and they get the cash back after 2 years with accrued interest. So literally, like, they're never gonna vote for a deal, most of these guys. They're just gonna get their cash back plus like 1% interest. So like that's, unless the custodian bank goes bankrupt or like commits fraud and drains the account, it's riskless to them. What they do get is they get the free option, other than earning 1% bond like return, they get a free option that deal takes off with retail investors and they could sell it before it ever closes. So they never actually took fundamental risk. And that they get the warrants associated with the closed acquisition to have a lot of value usually. So like those guys, if you find a sponsor that those guys think can get a deal done, they'll give it money. So like, it really is a funding mechanism that's riskless to the sponsor usually. If, they just need a bank to underwrite it. They need to find some people who are willing to trust that they can get a deal done. And so, I mean, yeah, it's accurate. It's a way of like pawning off these deals to retail where the initial funders of the SPAC aren't the ones who are like funding the VC firm, right? Like the VC firm or the P firm or whoever is really just, they're like, hey, let me borrow this money from you guys at 1%. In return for that, I'll give you warrants on this deal. And then when the deal is actually about to close, you can flip the whole deal to like retail investors, just put together a nice presentation and convince them why this is a great deal. And I would say that the things I would look for what makes a good SPAC personally, like first of all, the quality of the business, obviously. A lot of times SPACs, when they do deals, it's with very low quality businesses. They don't show a lot of operating history. They'll show maybe like a year or 2 years of adjusted numbers. The management team that's selling into the SPAC, they're taking a lot of cash off the table. That's a negative. Like I think successful SPACs, they just want to use this as a way to go public, but to raise money for the actual company, but not to take money off the table for themselves. Like if you see the SPAC, like people selling the business into the SPAC, taking, most of their consideration in cash, that's like, okay, you don't like the valuation of this business at this price, so you'd prefer cash. Like at the same time, you're asking investors to buy in at that valuation. So that's something I want to see long operating history with a high quality business where the management team is rolling a significant chunk of their investment in the business in along with the SPAC holders. I want to see a sponsor that has a lot of skin in the game as well, right? So the people who are selling the business, the management team are staying on board and they have skin in the game. And the person who's choosing the deal and deciding how much to pay for that deal, they have a lot of skin in the game. And the track record of doing this, even if not in SPAC form, in other, they have a long track record of investing success. So like those, just off the top of my head, those are like the few things I think you should be looking for, unless you're just playing the greater fool game, in which case you should just be looking for the story that's going to sell the best to the next fool and that the Robin Hooders are going to get excited about, which is what's been going on in a lot of these names.
So Nikola is actually it was a SPAC company, right?
I think it was. I haven't spent that much time on it, but yeah, I'm pretty sure it was.
Yeah, I'm pretty sure it was. Public, yeah. And I thought that Neo might have been as well, but I'm pretty sure that one of the electric vehicle companies was SPAC'd into the marketplace. And of course, you look at Nikola, and it went from, what appears to be $3 to almost $100. Again, it's that pent up thing that's going on. Yaron just left us.
I'm sure I'll come back.
I mean, scared him away.
What popped in my head, because we talked about EV. I think it was not this last one, but the one before. Where's Yaron? He's gonna like this question.
He's gonna come back.
Yeah,
we're talking about Tesla, and I was talking about Ford, and I think it was Yaron who asked the question about, well, why isn't Ford doing anything? Interestingly enough, they just put a $2.5 billion investment into Rivian. Okay, and Rivian is literally they're almost located across the street. I mean, they're only about 10 minutes away from where Ford is located. I try to check into it and find out, but but again, I mean, these things are, and the commentary on Tesla thing, it reminded me again, is that when you really look at it, none of the car manufacturers have done much yet in electric vehicles. I know that Chevy brought out the Volt and Nissan brought out the Leaf, and that's been it. Okay, but they've been around for what, 6-7 years now?
I got a question for you, Kevin.
Yeah.
What's the #1 most popular stock on Robinhood today?
Ford.
Yeah.
The interesting thing about it is because, one of the reasons for it might very well be that they try to announce
the
Ford 150 electric. They withdrew it from the marketplace because of the COVID stuff. But again, now what's happening is that they may flip-flop and use the skateboard, which is the underpinnings of the Rivian, Rivian private company. Again, they may find that the Rivian is a better product than what they've been working on for a while. But again, it's the fascinating commentary. I still don't believe that Tesla is a software company. I think it's a car manufacturer.
Absolutely. They'll realize that. The investors will realize that one day.
The interesting thing about it is that there was commentary, I'd say 15 years ago, but maybe even 20 years ago, when Ford, I worked with the electronics people and their module designers in broad terms. And one of the things that they were looking at was being able to download, as appropriate, upgrades to their operating systems and upgrades to their module design, so that they could actually do changes on the fly. Okay, which is what software companies do in general. Let's get the software out there; it'll work 80% of the time. We'll fix it. We'll get people, version upgrades. And it came to the conclusion that Ford said, "No way, we're not going to do that. We're not going to have half-assed software running cars. Okay, where we have liability associated with it." And they said, "No, it's going to go out. It's going to go out right." So there's quite a bit of interesting stuff going on. Again, it's really quite funny. I have that background, so as a result, I have a kind of a cynical view toward Tesla, and I should be talking to was it Garvin, who was the the car
You're
down.
gonna love it. We're actually recording our ESG impact investing panel for the event
Oh,
tomorrow.
geez.
You're gonna,
I tell you,
you're gonna love it. It's
I
really,
know, I know. Get me on that one. I'm going to be just as great. No, you don't have to. I'm sorry, but okay. So sorry, I interrupted your introduction about what I thought was going to be Tesla.
Well, it's sort of. I mean, my question being, and this is something that, look, as a admitted millennial, I guess that was a Freudian.
Yeah,
I
I'm
knew
an
you
old
were a
guy.
millennial. That's how you admit it.
Admitted millennial, is, I think we could all also agree. I don't want to speak for anybody, but look, we want to see, climate, we want to limit climate change, and we want to see, more electronic vehicles, and we want to see the change. But right now, I mean, you can't help but ask the question, what's a bigger bubble? The EV market, the SPAC market, or the SPAC for EV market? I mean, it's kind of a funny thing that we're seeing right now. I mean, maybe not that funny.
A SPAC for EV market really takes into all the considerations that you need to go crazy.
Perfect storm.
Create that
storm,
bubble,
sure.
Should we save that for next week? Maybe we should save that for next week. Is that a question for next week?
Yeah,
No, I think it's probably company specific, but
Of course.
I don't know. I mean, Tesla's valuation recently has gotten pretty extreme. So have some SPACs. Some aren't going to end well. I have no idea what's going to happen with Tesla.
All right, guys.
Hey, Yaron, did you check out Dama Mamadan? I think I can't say his name.
Oh yeah, I
Damadan.
did. Interesting guy. Very interesting.
Very,
guy.
very interesting guy. I mean, you go back and look at his valuations on Tesla, and I told you it was
He
pretty
was
well
wrong.
beat. He's wrong. Yeah, is he wrong or is he right, or is he too early or too late? Pretty interesting stuff though, from valuations perspective.
All right, guys. Sorry, I don't mean to cut it off, but we gotta end it. Everybody, give where people can find you. Don't worry, we'll stop recording. We'll talk more. Don't worry. But please, everybody, give your where people can find you on both social and your website. So, Stephen, let's go with you.
WillowOakFunds.com. Willow Oak Asset Management is a company that we run, and my funds are Arquitos Capital, ARQUITOS, and I can be found on Twitter at Stephen_Kiel, KIEL.
Cool, Kevin.
I'm Kevin, the good prick, on Twitter, but I don't use it because I don't really care.
Oh, yeah, I got you to use it the other day. You
commented. Yeah, that was classic too. How much money did she make, Bobby, by the way?
I tried to get her to. Kevin's referring to a video I did with my daughter, and she's very demanding. I mean, I got to tell you, it's a little thing.
That was well done, by the way.
I tried to sell her on doing it as a weekly, but then she had too many demands, so I had to. All right, okay, fine, no weekly. Sorry, you're on.
You could find me on Twitter, One Main Capital, the website, onemaincapital.com, and my email address is both on my Twitter handle as well as on the website, so feel free to reach out via email.
Awesome. And my name is Robert Kraft. You follow me on Twitter at Bobby K. Kraft, BOBBYKKRAFT. And you can find this on our YouTube channel, SNN Network YouTube channel. That's youtube.com /SNN Wire. Thank you all for joining me today, and maybe see some of you next week.
Thanks, guys.
Hey, Bob. Thank you.
Thank you.